All right, guys, welcome back. We're going to dive into life insurance. I'm going to give an introduction and then I'll talk about in future videos a few of the different considerations that go into what types of life insurance and strategies that you can use. Now, the main risk when we get life insurance, right, we always talk about the main risk that we're insuring against. This is the risk that we want to transfer away from ourselves to an insurance company. Okay. In this case, it is loss of life. The biggest risk, financially speaking, with the loss of your life is your loss of income potential. Okay. If you are the main breadwinner or you are bringing in the main income into the home, if all of a sudden that went away, that would obviously be financially devastating. Why? Because you can't meet your current expenses, your debt payments and other obligations. You wouldn't be able to save and invest for short-term goals and long-term goals. All of that would evaporate. Okay. That is obviously a huge deal. So our biggest asset that we have is our own potential to earn money. And so we have to insure against that. With disability coverage, we are doing the same thing. We're covering our loss of income through disability. This, we're just protecting it against death. Okay. So when do you need life insurance? If you are young and you do not have any dependents, like you are not married, you don't have kids, you don't have anybody relying on you financially, it's just you're young, then you may not need life insurance right now. If we're insuring against the loss of income, if you were to pass away, then nobody needs that income, right? Everybody else has their income taken care of. And so you're not insuring against your loss of income if you are the only one relying on your income, okay? But if you have dependents, that changes quickly, right? If you have a spouse and kids that need income and you go away, then that is a big problem. And so you think about that a little bit, right? If you need it or not at this point. Okay. Now, there are other reasons maybe you still want to get some. I'll talk about those in a minute. But essentially, the way that life insurance works, then, there's a lot of companies out there and they say, hey, you pay us a premium. Based on all these factors I'll talk about in a minute, you pay the premium, we will guarantee a death benefit. Okay, that's it. So we are paying for a death benefit. That is the total amount of life insurance coverage that is insuring your life. So if you die, you get the death benefit. Your beneficiaries get the death benefit. Okay, so here are the factors that go into underwriting. When life insurance, they look at your application and they underwrite it and they determine if they're going to accept or reject it. Because some people can't get life insurance. That's important to know. Not everybody can get it. You have to qualify for it. Okay, they don't just accept everybody. There are some risks that are too great for them to accept. Okay, so these are life insurance. When they get the application, they underwrite it and they say, okay, are we going to accept it or not? And then if we accept it, based on all these factors, what premium are we comfortable with, to insure against with this death benefit? What premium do we need to make that worth it for us? Okay, so they do all the complicated math and they come back with an answer. Here are some of the factors that go into that. Number one is age. Obviously, the older you are, the more likely you are to die or have some health problem that causes you to die. The younger you are, the less risky you are, generally speaking. Gender. Males have a higher risk factor than females. I don't know why, but that's just what the math says. You could probably think about some theories there. Your health, right? So they're going to look at your height to weight ratio. They're going to say, hey, is this person overweight? Are they underweight? What are the potential problems that could cause, right? If you're overweight or obese, for example, that could lead to other health conditions that are serious. It could lead to diabetes or heart failure or high blood pressure, right? Things of that nature that cause the risk to the insurance company to increase, right? So there's a lot of things they can tell by just the height to weight ratio. Tobacco use is another one. If chewing tobacco or cigarettes, right, that is a big one they will always ask because that obviously has a massive impact on your health. They will look at family health history. So they'll say, hey, does anybody in your family have a history of this type of problem or this type of problem or this type of problem? Tell us about your siblings. Tell us about your parents. Did they have any of these problems before a certain age, right? So they're trying to get an idea if there is something genetic that is commonly passed down, that they have to factor into their risk calculations. Medical history is also important. So they want to know about your family history, your current health, but also what problems have you had in the past? What have been your hospitalizations? What were they for? When were they, right? They're going to go through all of that history because they want to really understand what they are insuring. They want to make sure they have a solid understanding. They're going to look at your lifestyle. So certain lifestyles are more risky than others, right? If you just sit on the couch all day, well, maybe that's risky in another way because you don't exercise. but if you engage in other behaviors that are maybe out of the ordinary, then they could be considered extra risky, right? Some of these would be like, do you go skydiving? Do you go bungee jumping? Do you go rock climbing? Are you traveling? Do you plan to travel to any place? And where is that place? Is there any heightened sense of security or safety precautions that factor in based on that, right? Are you in the military, right? Like there's all of these things that go into your lifestyle that could cause additional risk. Do you scuba dive? These are all questions that will factor in. And then they'll also look at your driving record, right? If you have DUIs or you've gotten into a lot of accidents or you've gotten a lot of speeding tickets, that is a massive risk factor that they want to factor into the whole equation. Okay, so there are others. These are the common ones, but you kind of get the idea, right? Age, gender, health, and lifestyle. You can kind of sum it up that way. So based on all those factors, they determine premium to cover the death benefit that you are seeking. Okay. Now, the other thing I'll talk about here is there are a number of different ways to calculate an insurance need. So you might think, hey, how much insurance do I actually need though? Because a lot of people don't like paying for insurance. As we've talked about before, we're just getting coverage, right? We're getting protection, but we really don't see the benefit of it unless there's a problem. If there's a problem, we're grateful we have insurance coverage. If there's no problem, it just feels like we've paid a premium for nothing, essentially. And so some people want to really decide what's the minimum amount I can get away with because they don't like the expense of the premium, okay? Here are the three main ways that you are going to calculate that are commonly used to calculate the insurance need. Number one, simply a multiple of income. So you take your annual income times by a number, commonly 7 to 10 years. And there you go. That's the easiest approach. And it might not factor in all other financial factors, right? It doesn't really take into account other variables, but it's very simple. You say, hey, my annual income times 10 and we're good to go. Okay? You can do that. Another one is the human life value approach. This seeks to replace all future income. So you calculate your income from now to retirement, including what you might anticipate in increases in income, right, over the years as you get promotions and raises and things like that. And you would calculate that total amount, and that is the amount that you would insure. If you earn $100,000 a year and you want to insure yourself for 20 years, essentially, right, then it's similar to the multiple of income approach, but you kind of factor in increases, right? Then you do that. You just add it up. 100,000 this year, 105,000 next year, 110,000, add it up all the way to retirement, and then calculate that as your need, okay? The third way is a capital needs analysis. This includes all the other variables that you might have in place. So you cover loss of income, but you also factor in enough money to cover debt payoff. So like, well, I'll want to pay off our mortgage, and I also want to pay off our auto loans, and maybe we have some student loans left. I want to make sure those are paid off, right? So that as a lump sum, the cash value, the death benefit comes in and you pay off these different obligations. And also including future things like college funding for kids. Like, well, if I pass away, I can't save for college for my kids. So I'm going to have part of that death benefit be set aside to fund college tuition for our kids, right? So there's a lot of ways to make that work. A lot of the different variables that you would pack in there that you want covered. And then one other question as you're kind of deciding this is, am I going to live on the interest only, like the gains of this life insurance death benefit, or am I okay using some of the principal? Okay, as we talked about in the financial calculator, right, where we put in the withdrawal rate and things like that, if you take the lump sum death benefit and you invest it in the stock market, let's say, and you want to do the interest only, you don't want to use up the principal, you just only want to use the gains, then you would calculate things a little bit differently, right? You would take the death benefit times by 4% perhaps, and say, okay, that's our annual income. Is that going to be enough? Using principal, you don't necessarily need to be as careful about a 4% rule or whatever. You end up saying, hey, here's the death benefit. And by the end, we've used up pretty much everything, right? All the gains and the principal. So by the time my beneficiary has died, or like spouse specifically, then there's not really a whole lot of money left, right? It just gets them enough to cross the finish line. Whereas interest only, you still have a big principal amount still left upon the death of your spouse, because they've just been using the gains to live on. So you just walk through some of those. My preference, I do capital needs analysis. So I look at paying off debt. I look at funding future goals. I look at loss of income. And that's how I calculate it, generally speaking. Okay. I'll talk about some reasons as we dive into future videos. So what we're going to do now is talk about some of the different kinds of life insurance, compare and contrast. First, we're going to discuss term life. Then we'll talk about permanent insurance, which there's a number of variations on permanent insurance. So I'll kind of cover the differences there. And this will help you sort through what are the differences and when might each type be useful. All right. So without further ado, let's move on.
Make the future easier.